Welcome to our explainer, where today we are diving headfirst into one of the trickiest accounting standards out there, Ind AS 116, all about leases. You know, if you've ever wondered how a seemingly simple change to a rental agreement can send ripples straight to a company's bottom line, you are in exactly the right place. We're going to break it all down. So let's start with the big question, right? What is it about this particular standard that makes it so notoriously difficult to get right? I mean, it trips up even the most seasoned professionals. So let's figure out why. You see, the real challenge is that this standard is anything but static. It's dynamic. Unlike the old rules, it forces you to constantly reassess your leases using new discount rates. So any little change can create this huge ripple effect that goes right to a company's equity. The numbers are always moving, and that makes getting the details absolutely critical. So here's how we're going to get a handle on this. We're going to tackle three of the biggest challenges: what to do when your lease terms change, how to solve the sublease puzzle, and then how you even choose the right path to get started with this standard. And then we'll tie it all together. All right, let's jump into that first big hurdle, modification accounting. So you've got your lease all perfectly recorded on the books, and then, boom, something changes. What do? Well, the standard actually has a very specific name for this. It's called a lease modification. And really, you can think of it as any kind of deviation from the original plan. Maybe you need more office space because the company's growing. Or maybe you negotiated a better price. Heck, even deciding to end a lease early counts as a modification. And right here is where you hit your first major fork in the road. The standard basically forces you to make a choice. Are you going to treat this change as a completely brand new separate lease? Or do you have to go back and rework all the numbers for the original one? The deciding factor really boils down to whether you're adding something new, like more space at its current market price. Now, adding space, that's one thing. But the accounting gets really interesting when you do the opposite, when you decrease the scope of the lease. Let's say your company decides to downsize, and now you only need half the office you originally signed up for. When that happens, there's a very clear process to follow. First, you decrease both the asset and the liability on your books. But here's the kicker. The crucial part you see in that final box: if those two numbers don't perfectly cancel each other out, the difference doesn't get spread out over time. No, it hits your bottom line immediately as a gain or a loss on your P&L statement. Okay, let's make this real with an example right from the source material. Imagine by cutting back on your office space, your liability, that's the money you owe in the future, it drops by just over 1 lakh rupees. But then you do the math for the other side of the equation, the proportional reduction in your right-of-use asset. You know, the value of your right to use that space. And that number comes out a little bit lower, just under 92,000 rupees. And there you have it. That difference, 13,285.5 rupees, is recognized instantly as a gain on your P&L. That is a direct, tangible financial impact that comes from just changing your lease terms. So that covers what happens when you change a lease. But what if you decide to lease out that space to somebody else? Well, this brings us to the sublease puzzle. And to solve it, you basically have to rewire your brain about what an asset actually is. Okay, so you're a lessee and you decide to sublease a property to another company. You have to classify that sublease. But before you can even think about doing that, you have to correctly answer this one very fundamental question. And here is the big mental shift. You are not subleasing the physical building. The asset that you control, the one that's actually on your balance sheet, is your right-of-use asset. It's your contractual right to use that space for a limited time. And that is the asset you need to evaluate. Look, the guidance itself is crystal clear on this point. As the one in the middle, the intermediate lessor, your asset isn't the bricks and mortar, It's the contractual right that you hold. Getting this distinction right is the absolute key because it changes how you classify everything that comes next. So check out this example. Let's say your main lease gave you a 5-year right of use asset, and then you turn around and sublease it for 4 of those 5 years. Well, you've just transferred 80% of its economic life. That's a huge portion, and it's enough to cross the threshold, making it a finance lease from your perspective. We've seen how to handle changes and subleases, but that kind of begs a bigger question, right? How does a company even begin to apply this beast of a standard? And that brings us to our final topic, choosing your transition path. When adopting this standard, companies get a choice. They can take the full retrospective path, which is a massive amount of work. You have to go back and restate all your past financial years. Or they can choose a much simpler, modified approach. And believe me, the path they choose can have a dramatic impact on their financials, especially on their equity. So, for most companies, alternative 2 of that modified approach is the most practical way to go. And why is that? Well, it's pretty simple. You don't have to restate any prior years, and this is a real clincher, you set your asset to be equal to your liability on day 1. The result? 0 impact on your opening equity. It's a clean, simple start. Whew. Okay. We have waded through a lot of complexity. So let's just boil it all down. What are the absolute most important things you need to walk away with from this standard? Think of this as your checklist. For modifications, you gotta know which path to take. For decreases in scope, be ready for that immediate P&L hit. For subleases, just keep repeating, it's all about your right of use asset. And for transition, make a strategic choice that actually fits your business. If you can get these 4 things right, you are well on your way to mastering Ind AS 116. And that leaves us with a final thought to mull over. While accounting often feels like a world of very rigid rules, true understanding comes from knowing the choices that are embedded within those rules. Because it's in those choices that accounting really meets strategy.